Welcome to Finance Explorer. Today, we're diving into the world of bonds and bills, two essential pillars of finance that can shape your investment strategy. Whether you're a seasoned investor or just starting out, understanding these financial instruments is key to building your wealth. So, grab a seat, and let's explore how bonds and bills work, their differences, and how they can fit into your financial plans. Let's get started. Bonds and bills are both types of debt securities, but they have key differences. Here's a breakdown. 1. Definition. Bonds. Long-term debt instruments issued by corporations or governments to raise funds, promising to pay periodic interest and return the principal at maturity. Bills. Short-term debt securities, typically issued by governments, with maturities of 1 year or less. They are sold at a discount and pay no interest. The return comes from the difference between the purchase price and the face value. 2. Maturity. Bonds usually have longer maturities, ranging from several years to several decades, often 10, 20, or 30 years. Bills have short maturities, commonly ranging from a few days to 1 year. 3. Interest payments. Bonds typically pay periodic interest, coupon payments, throughout their life, which is a percentage of the principal amount. Bills do not pay interest. Instead, they are issued at a discount to their face value, and the return is the difference between the purchase price and the face value when they mature. 4. Risk and return. Bonds generally considered riskier than bills due to their longer duration and exposure to interest rate changes. They may offer higher returns as a result. Bills, considered lower risk because they have shorter maturities and are typically backed by the government, like U.S. Treasury bills, making them safer investments. 5. Purpose. Bonds often used to fund long-term projects or operations, infrastructure, corporate expansion, etc. Bills used for short-term financing needs, such as managing cash flow or covering immediate expenses. 6. Market availability. Bonds traded in various markets, including corporate and municipal bonds, and come in various types, e.g., government bonds, municipal bonds, corporate bonds. Bills, most commonly associated with government securities, such as Treasury bills in the U.S. Let's dive deeper into the differences between bonds and bills, covering various aspects such as types, pricing, taxation, and market behavior. 1. Types. Bonds. 1. Corporate bonds. Issued by companies to raise capital. They typically offer higher interest rates than government bonds due to higher risk. 2. Government bonds. Issued by national governments, e.g., U.S. Treasury bonds. Considered low-risk investments. 3. Municipal bonds. Issued by states or local governments. Often tax-exempt at the federal level, and sometimes at the state and local levels as well. 4. Convertible bonds. Can be converted into a predetermined number of the company's equity shares. 5. Zero-coupon bonds. Sold at a discount and do not pay periodic interest. The return is the difference between the purchase price and the face value at maturity. Bills. 1. Treasury bills, T-bills, issued by the U.S. government with maturities of 4, 8, 13, 26, or 52 weeks. They are sold at a discount and have no interest payments. 2. Commercial paper. Short-term unsecured promissory notes issued by corporations, generally maturing in 1 to 270 days. 2. Pricing. Bonds priced based on their face value, interest rate, coupon rate, and market conditions. When interest rates rise, bond prices typically fall, and vice versa. Bills sold at a discount to their face value. For example, a $1,000 trillion bill may be sold for $950. Upon maturity, the investor receives the full $1,000. 3. Interest payments. Bonds. 1. Coupon payments. Made periodically, usually semi-annually, based on the bond's coupon rate. For example, a $1,000 bond with a 5% coupon pays $50 annually. 2. Yield to maturity, YTM, reflects the total return anticipated if the bond is held until maturity, considering both coupon payments and any capital gain or loss. Bills, discounted nature, no periodic interest payments. The return is realized at maturity when the bill is redeemed for its face value. 4. Tax considerations. Bonds. Interest income from corporate and government bonds is typically taxable. Interest from municipal bonds is often exempt from federal income tax and sometimes from state taxes. 2. Bills. The interest earned from T-bills is subject to federal tax but generally exempt from state and local taxes. 5. Market behavior. Bonds. Sensitive to changes in interest rates, inflation, and credit ratings. Economic conditions can greatly affect their prices and yields. Can be traded on secondary markets, providing liquidity but also price fluctuations based on market sentiment. Bills. Generally considered a safe investment, especially T-bills, which are backed by the U.S. government. Less volatile than bonds due to their short maturity and low risk. 6. Investment strategies. Bonds. Suitable for investors seeking income through interest payments and capital preservation. They are often included in diversified portfolios to balance risk. Bills. Ideal for conservative investors looking for a safe place to park cash temporarily or those wanting to manage short-term liquidity needs. Summary: in essence, bonds are long-term investments that provide periodic interest payments, while bills are short-term securities sold at a discount with no interest payments. Understanding these differences can help you choose the right investment based on your financial goals and risk tolerance.